In the previous video, we saw how the tragedy of the commons could be analyzed and understood using game theory. Here, we'll analyze several strategies for mitigating the tragedy of the commons, again using game theory. Recall that a commons is a limited resource shared among many users in such a way that each user makes use of as much of the resources they want. And a tragedy of the commons arises when rational exploitation of an unregulated commons leads to overuse of the resource. Since the shared resource is at the center of the tragedy of the commons, one possible solution is to eliminate the commons through privatization. That is, split the commons up among the parties involved, and then each party can make better decisions about their personal property. Many of the common pasture lands that historically were used in Britain have been privatized. Another option is regulation. Government can set limits on individual use, along with penalties for individuals who exceed that limit. Ideally, then individual limits are set so that the total use of the commons is not too great. Both of these strategies are used in a variety of settings. However, in this lecture, I'm going to focus on the second two strategies, cap and trade and revenue neutral use taxes. These strategies work within the market system and have been used with success to address sustainability issues. Let's start with cap and trade. This approach is a combination of regulation and market strategies. The regulation piece comes through an overall limit on the use of the commons, coupled with permits issued for the use. The market component is introduced through the ability to trade permits. In the context of grazing, this might look like a maximum of 10 cows permitted on the commons, with a corresponding 10 permits, one for each cow, issued to farmers. Then farmers can trade permits to allow them to get the best balance of cows across the various farmers. We'll analyze this scenario more carefully using game theory, but first I want to talk about a real-life cap and trade policy. One of the great cap and trade success stories is acid rain in the US. Acid rain is created when sulfur dioxide and nitrogen oxides mix into the atmosphere and then precipitate back to the ground. Acid rain acidifies waterways and causes a variety of leaching from soil, leading to devastation in a variety of ecosystems. Acid rain was a significant problem in the northeastern United States in the 70s and 80s, primarily as a result of emissions from power plants. In 1990, the Bush administration introduced legislation to combat acid rain through a clean air market. This was the first large-scale pollution cap and trade program. Unlike prior regulation programs, it included no prescription on how pollution would be reduced, but rather tried to create market incentives for businesses to find their own solutions. In the initial implementation, permits were freely distributed, but then caps were slowly lowered over time. By 2007, 17 years after the law was passed, sulfur dioxide emissions had declined by 43%. Let's go back to the grazing example to understand a cap and trade system in more detail. Recall that in this example, the overall milk production for the commons was maximized when there were 10 cows on the commons, so this is set as the cap. Initially, each farmer is issued 5 permits. As the farmers approach the commons limit, this creates options for them. Suppose each farmer currently has 4 cows on the commons. Then each farmer is producing 24 gallons of milk. Since each farmer has 1 remaining permit, they could either add 1 more cow, or the farmers could exchange a permit, allowing one farmer to have 6 cows and the other to have 4. Note that the final 3 scenarios all allow 10 cows on the commons, creating a total of 50 gallons of milk produced. This maximizes the overall amount of milk produced. But the system now allows some flexibility. If farmer A has extra cows, they may be able to negotiate with B for a permit in a way that doesn't disadvantage B. In particular, the calculations we've done suggest that a fair price for the permit might be 5 gallons of milk, as this gives the farmers the same production level as if they had each put 5 cows on the commons. Of course, this is a free exchange, so the farmers may actually settle on a different price depending on their individual circumstances. Another strategy to address the tragedy of the commons is a revenue-neutral tax. In such a system, individual users pay a tax based on what portion of the commons they use. Then, the proceeds from the tax are split equally among all stakeholders and redistributed. This redistribution of the tax makes it revenue neutral. For example, in the grazing example, each farmer could be taxed by requiring that they turn over some of their milk for each cow they put on the commons. In this scenario, farmers with more cows pay more tax, but then the milk tax is split equally among all farmers, so that farmers with fewer cows may actually get more milk than they were taxed, but farmers with more cows will get less than they were taxed. A revenue-neutral tax has been espoused by a number of economists as a solution to carbon emissions. In 2008, British Columbia was the first government in North America to institute such a tax. The carbon tax is applied at the point of retail sale on fossil fuels used for electricity generation, home heating, and transportation. The tax is revenue neutral in that corporate and individual income taxes were reduced at an equivalent rate. This means that individuals and companies who are low users of fossil fuels may see a net decrease in taxes, while high users of fossil fuels may see a net increase. The idea is that this incentivizes individuals and companies to reduce their carbon emissions. In the first 5 years after the tax was put in place, British Columbia experienced a 17.4% drop in fossil fuel consumption, while the rest of Canada experienced a slight increase. Overall, the program is considered to have been an environmental success while having no detectable harm to the economy. To better understand how such a tax works, we'll work through the details for the grazing example. Suppose the farmers are required to pay 4 gallons of milk per cow put on the commons. If both farmers have 4 cows on the commons, they each pay 16 gallons of milk. But then this is equally distributed back to the farmers, so the farmers still have a net production of 24 gallons each. Similarly, if each farmer has 5 cows on the commons, then they each maintain 25 gallons of milk production. But things get more interesting when one farmer has more cows than the other. Let's look at the situation where A chooses to add a cow and B doesn't, so that A has 5 cows and B has 4 cows. Then the total number of cows on the commons is 9. And each cow produces 5.5 gallons. Since farmer A has 5 cows, their total production is 27.5 gallons. Farmer B has 4 cows, so their overall production is 22 gallons. And I can add this information to the table. Farmer A has 5 cows and thus pays a tax of 20 gallons, while Farmer B pays a tax of 16 gallons for their 4 cows. A total of 36 gallons of milk is paid. This is split in 2 and paid back out to the farmers, so each farmer receives an 18-gallon refund. Notice that Farmer A has a net loss of 2 gallons for a total of 25.5 gallons, and Farmer B has a net gain of 2 gallons for a final total of 24 gallons. We can enter this in the payoff matrix. The same analysis would show that we get the reverse payoff if Farmer B decides to add a cow and Farmer A doesn't. Looking at this payoff matrix, we can see that Farmer A gets the highest milk production by adding a cow, whether Farmer B adds a cow or not. That is, adding a cow is a dominant strategy for Farmer A. Similarly, adding a cow is a dominant strategy for Farmer B. This shows that the tax doesn't discourage farmers from adding cows to the commons when they're below the optimal value of 10 cows total. But what happens when both farmers have 5 cows on the commons? I calculated the payoff matrix shown, assuming that both farmers have 5 cows to start with. Notice that if B doesn't add a cow, A gets the same benefit whether they add a cow or not. Whereas if B does add a cow, it is better for A to not add a cow. So not adding a cow is a dominant strategy for A. Similarly, if A doesn't add a cow, B gets the same benefit whether they add a cow or not. Whereas if A does add a cow, it is better for B to not add a cow. So not adding a cow is a dominant strategy for B as well. We end up with a Nash equilibrium where both farmers choose not to add a cow. For the tax level set in this example, the revenue-neutral tax helps the farmers avoid overusing the pasture and thus averts a tragedy of the commons.